Good morning and good afternoon, everyone. Thanks for taking the time to join the webinar on how to measure success in the cash flow hedging program. My name is Ian Argue. I'm one of the co-presenters along with Scott Bilter of Atlas Risk Advisory Group. We'll just be going through the webinar in the next half hour here or so, and I'll kick it over to Scott to begin the presentation. Thanks.
Okay, thank you, Ian. And yes, this is Scott Bilter. I think I may be showing up on the webinar as John O'Tenney. That's just our go-to webinar login. So I am not, in fact, John O'Tenney. I am Scott Bilter. And so during this session, we are going to talk about why a successful cash flow hedging program is important both internally and externally, so both in investors and then inside your company for many folks. How a successful program ideally minimizes downside risk and smooths out FX impacts over time. That might sound very obvious, but we've seen a lot of cases where folks don't really have that approach. They may be just trying to maximize upside and guess which way rates are going. So if you have any folks that you talk to that are trying to pull the banks and find out which way the euro is going to go the next year, or yen, or some other currency, it's probably not the best approach. It's a little bit on the dysfunctional side, I'd say, and not necessarily going about it the right way. And then we'll talk about how all potential areas of noise in the cash flow hedging program are quantified and analyzed. And then to the extent that there's probably some folks out listening to this that may not have a cash flow hedging program in place but are looking to put one in place, if you've not yet tackled the hedge accounting aspect of that, Ian will talk about some hedge accounting basics at the end as well. Okay. So just to clarify what we're talking about here when we use the term cash flow hedging, which is actually a little bit of a misnomer. I think the Financial Accounting Standards Board, or FASB, didn't do anyone any favors when they gave FAS 133 the name of cash flow hedging way back when. So just to clarify what we're talking about, if in this simple exposure timeline, following the exposure on the revenue side, you have a future order, eventually becomes a firm order, you've got backlog, and then you have the revenue recognition date. That is typically the timeline of a FAS 133 hedge. It's not actually the entire cash flow, so that's why it's a bit of a misnomer. So to the extent that you have the month that the revenue becomes a receivable, and then you're still waiting for the collection of that receivable on the balance sheet, that would typically be taken on the balance sheet hedge or FAS 52 program. It's definitely possible to have one trade cover the whole entire cash flow, true cash flow, and maybe gets de-designated from a FAS 133 hedge to a FAS 52 hedge at that time of revenue recognition, or if you're on the expense side at the time of expense recognition and hedging a payable. And that's a perfectly good way of doing it. It's actually a very good way of doing it. But we're just talking about the period just to clarify for today, of when you want the hedge accounting or the delayed mark-to-market to be occurring. And so that is the timeline that we're talking about for the cash flow hedging today. So that'll be the last that we talk about balance sheet hedging. Okay, next slide. So before even getting into cash flow hedging and makes a successful program, there's a question of why hedge at all. And there's a lot of arguments that come up against hedging, and they are typically pretty flawed. And some of the arguments we often hear is that, well, it all evens out over time. So long-term foreign exchange, it's a zero-sum game. The problem with that is that over time is often longer than the tenure of the folks that are going to be held accountable for the results, whether that's the CEO or CFO or treasurer. Over time could be a very long period of time. So it doesn't necessarily, it's not, over time is a little bit too long for most folks. And even if it is a zero-sum game over a long period of time, a set of cash flows with less volatility is still more valuable to investors. So to the extent that you can reduce the beta of your stock with a cash flow hedging program, you're going to make those sets of cash flows more valuable to them, all else being equal. Another thing we often hear is that, well, we provide constant currency analysis to our investors. So that might be something along the lines, and I've certainly heard that a lot of the last few years with the dollar strengthening. If you have, for an example, they may tell investors, well, we had 3% growth from a GAAP perspective, but on a constant currency basis, year over year, we would have had 7% growth. So what they're basically saying is that if the FX rate environment today was exactly what it was a year ago, we would have reported 7% growth instead of 3%. So they're trying to basically help guide up the true growth rate of the company. Now the true growth rate is probably somewhere in between that 3% and 7% in that example. And it is a somewhat helpful metric to give to investors so they can help determine themselves what the growth rate is, because that obviously would have a huge impact on the value of a company at those two different growth rates. But still, you can do more for them. The investors, it still leaves them with an unnecessary risk that they can't or don't want to deal with. So not quite good enough. If you have a material amount that you can hedge, you really should have a cash flow hedging program in place. Another thing we sometimes hear is that, well, we're giving our regions or businesses local currency-based targets, and that's a fine thing to do in many cases. It can be the right thing if you have local currency-based quotas and set that once a year and have them not actually worry about the dollar-based results. But some folks in the company are going to be held responsible for the dollar equivalent plan. So it's not a good enough excuse for not hedging. Another one I actually didn't put on this slide, but of a bit ago that we often hear is that, well, if you're transacting everything in dollars, we don't have an FX issue at our company. But you may be creating other problems by doing that. If you're forcing dollar pricing on your customers, for example, that would prefer to pay in local currency, you're probably getting some extra hedging costs embedded. You're not getting as much as you could, and they're probably inflating those hedging costs to deal in the currency that you want to deal with and not theirs. Or if it's maybe a distributor, for example, you could be changing more easily dealt with FX risk into a credit risk. So there's certainly been cases where low margin distributors that if you're a major piece of their business and you're forcing dollar pricing on them, if their currency has a huge devaluation, they may go bankrupt, and all of a sudden you've got a much tougher issue to deal with. So most of the arguments against hedging are not very good ones. Next slide. So if you've decided to hedge, then often a lot of folks will look at what's the administratively easiest way to do it, and most companies have a plan of setting some rates once a year for an annual plan. You have to put a stake in the ground at some point and make a guess, usually just what the current rates are, and say, all right, well, everyone forecasting euros, use this rate for the year, yen, use this rate for the year, and boy, wouldn't it be easy, just why don't we hedge at that rate, and then everyone's covered. But the problem is you can catch some spikes and have a huge, that's not really hedging. And I'm kind of cherry picking an example here, but in March 2014, that was kind of the last bit of time where the dollar had a period of stability for a while, and then it dropped pretty rapidly. So from March 2014 to March 2015 went from 139, the euro went from 139 to 105, so a 25% drop in 1 year. If that happened to be the time that you communicated rates internally for your plan, so this wouldn't be a calendar year, fiscal year, but if you have that, then you'd be hedging for an entire year at rates so dramatically different that when your last hedge runs out at 139 and your first hedge picks up at 105 1 month later, your business can't handle that type of volatility. It just does not make sense to push that type of sort of staircase effect to the business. So to talk about some better ways of dealing with that, I'll pass it along to Ian, and he'll discuss some better ways.
Thanks, Scott. So what we've done here is we've put together 2 examples of common strategies that are used to hedge cash flows. And the first one is a static hedge flow, cash flow hedge program. Sometimes we refer to it as a set it and forget it. And in this model, it's pretty straightforward. It's actually very simple, and the company would simply enter into all of its hedges for an entire year at a single point in time. So at the beginning of year 0, you set a 3-month hedge, 6, 9, and 12-month hedge. And in the example Scott just showed, it could be set at a rate of, let's say, 1.39. And at the end of year 0, you go through and you set your hedges for the following year. And then the worst case example you showed is at a rate of 105. The second example, or second method, is a rolling or layered hedge model. And it's a little bit more difficult to implement in practice, but it's still relatively straightforward. And in this case, hedges are entered into on a regular basis, and then they're entered into with relatively strict coverage ratios. So how much of the exposure do you hedge? So in this example, we're going through and we're setting hedge going out 4 quarters, and we're hedging 25% of each exposure. The end result is that the near quarter is hedged at 100%, the second at 75%, and so on. And the actual mechanics of how this works are defined in a policy so that you can adjust the actual coverage ratios for each period according to your preferences. But the key is that it's a systematic and mechanical approach to hedging. So carrying forward an actual example here of the period of 2014 to 2015, we put together an example of how these various strategies would work. So the blue line on the graph is the euro-dollar rate just for the 2-year period, a subset of the graph Scott showed earlier. The orange line is the static hedge program actual hedge rate, and the green line are the rolling quarterly hedge rate. And I think a couple things to note here. The static hedging program, the periodic change from 2014 to 15 is 12%, which is not the worst case example that Scott showed at 25%, but it is still a very significant jump. And you see a rate, realized rate moving from 138 to 121. And that's great if you're on the right side of it, but if you're on the wrong side, it's a very big shock to deal with. The rolling program, the average change is only 3% per period with a maximum 5.6, so much more digestible changes in hedge rate. Now, in terms of the rates you would realize over the period, and in environment with consistent directional trending, the average of the rolling rates will be very close to the actual static hedge rate, but that's only in cases where the trend continues. In cases where there's volatility, there's a much greater probability that the static program will significantly deviate from the average. So if we think of in terms of some of the benefits of using the rolling or layered hedge approach, for most operational programs, the approach is generally the best or a good option. The static program, as we mentioned before, it's conceptually very simple, but it requires reliable exposure data and still exposes you to sudden shock as your hedges roll off. And the real problem with the set it and forget it program is the forget it part of it. In general, it creates a pretty big disconnect between the Treasury and the business in two areas. So if you think about the one piece of the feedback loop of the business updating Treasury on exposure information, because you're only doing it annually, you find Treasuries generally become disconnected from what's going on. And then secondly, the other half of the feedback loop of Treasury talking to the businesses is that because the operations become disconnected from what's going on with currency rate and most importantly what the impact on their financial performance might be. Another issue with static program is the timing of the hedge becomes very important in the eye of the company. So you might be looking to catch a favorable spike, but that's very difficult to repeat on an ongoing basis. Because you're doing everything at one time, we find some companies end up taking an attitude of waiting for a favorable movement. And the program ends up becoming much more emotional than a mechanical process that you can explain and justify. The layered approach, it's a little bit more, it buys a little more time for changing business conditions. So it allows you, because you're constantly adding new hedges, to fine-tune them as volumes change, and it allows you to avoid those sudden shocks that we discussed earlier. I mean, there are a couple cases where layering for cash flows might not be the best option, and those are generally large one-off exposures, so capital purchases or issuances of foreign currency debt where you need special tailored strategies to deal with those exposure types. And I'll turn it back to you.
Okay, thanks, Ian. So one of the things with the cash flow hedging is really you need more of an understanding internally with your business partners than, say, balance sheet hedging. There's very little accountability for, balance sheet actuals outside of Treasury. Forecasting there is a little more, it's a little bit more difficult to bring that back to some metrics that mean something to folks. But on the FAS 133 side, the hedge items typically have pretty high accountability. So if it's, forecasted revenues or expenses, folks have, they're looking at those plans pretty frequently, and you want to make sure that they understand how gains and losses, if they are allocated to them, work with those plans. So because they are, accountable, they often, the FAS 133 gains and losses may be allocated to a business or geography or a combination. So whoever is eventually getting, being held responsible for the dollar-based results really should understand how those gain-loss impacts are hitting them. So you can't just provide the gain losses in isolation. Big problem with that, when you just give somebody a loss and don't explain how that is offset by, a tailwind that they've been operating under, then they're going to have 20/20 hindsight really fast and say, well, why did you guys hedge? Why did you hedge it? Everyone knew the euro was going to be coming down from this to this. Why did you guys hedge our expenses and give me all these losses, right? So if they already see how it's kind of, if Treasury's already built a bridge back to the accountable plan that they're familiar with, and say, yeah, but remember, here's the plan that you had your expenses assumed at this rate. Your actual expenses are this rate, much better. This is the offset to that gets you back to the plan. So in order to really make that successful, Treasury needs to work with FP&A to update and communicate a rolling plan that incorporates hedging. That's not always the annual plan. Just about every company does have this annual plan, but it's not always the one that matters a quarter or two into the year. Sometimes it gets trumped by, an updated quarterly rolling plan. And if the quarterly rolling plan is the one that folks are really being held to, then then Treasury needs to help build a bridge to that plan as well and incorporate some FX rates that may, may raise or lower that hurdle in terms of the metrics for everybody. And then, of course, there's going to be inevitable deltas between the plan and the actual results, and Treasury needs to help explain all of those. High-level dashboard for certain executives, more detailed for someone that wants to really understand the numbers. And there's a number of drivers there. There's, some volume-driven drivers and rate-driven drivers that will help explain those deltas. So next slide. So this is just an example of kind of a high-level dashboard that tries to explain some of what's going on in a cash flow hedging program. First of all, it's good to give feedback in terms of just the pure forecast deviation, and you can have forecasts that are bad and not have much of a rate impact from that, but it's still good to let people know that the forecast was off. So if you have some thresholds of what would be considered a yellow forecast, what would be a red forecast, if something's being distributed and someone responsible for a certain area sees yellow or red next to their area of responsibility, they're more likely to want to turn it green the next time around. So important to provide that red or yellow feedback to some of the poor forecasts. The next thing on this dashboard, and this is just an example of revenue and OPEX as being hedged items. It can be different things for your company. So just an example there. But the third item here, the impact of unhedged forecast. So with FAS 133 hedging, a lot of folks don't get to the 100% hedge level. They want to make sure they keep their hedge accounting treatment, and they're not sure about their forecasts, and so they don't want to overhedge. So for example, maybe your total forecast gets as high as 80%. So it's good to track what that 20% unhedged is doing compared to, again, the applicable planning rate, which ideally is, again, that rolling planning rate. But if you track, the impact of that and see if, if you have a huge delta, then that, and you find out that your forecasts are actually pretty good, then maybe you can true up that hedge level a little bit and get closer to 100% and not have that noise. The next item is comparing the hedge rate to the planning rate. So again, you don't want to go with the administratively easiest thing and just have a planning rate once a year that you're going to follow, because then you're either going to have a huge difference between your hedge rate and your planning rate if you're doing a rolling forecast, or you're having a very poor hedging strategy of hedging the entire year like Ian went over earlier. But there's likely going to be some slippage between the two, and that's, it could be that you're having to make a guess of what the future rates are going to be for future quarters that are not yet fully hedged. So your planning rate that you can communicate to the business would be a combination or a weighted average of what is already hedged now and your best guess of what will be hedged in the future. And your best guess is probably, today's spot rate, but of course that's not going to hold true, so there will be differences there. But this, showing this delta could highlight if there's any timing differences that aren't necessary. So if you can sync up, your layered hedging, and then right after that communicate the latest and greatest rate information you have for planning purposes, then that's ideal. So ideally with all this, you have your total income statement impact at a high level. On the far right here, we're even showing in terms of pennies per share, hopefully a fraction of a penny per share, because we all know that CFOs and CEOs do not like to talk about currency on earnings calls, and this kind of shows the magnitude, and if it's a small enough number, then they won't have to. Next slide. So this one's a little bit more detailed. So going from the kind of the dashboard view down to the nitty-gritty numbers here, but I tried to keep the numbers round and make it a little bit easier. So in terms of forecasts compared to actuals, we're just going with a quarter where we forecasted 100 million euro revenue. So we're just talking euro, we're just talking revenue. Very simple example. We have our monthly splits of 30, 40% for this period. The actual euro revenue, some monthly deviations, of course, but it didn't end up being too bad of a forecast for the quarter. The actual came in at 98 million. But the amount that's hedged for the policy, we're assuming an 80% hedge policy here. So you see the amount hedged is only 80 million. And then below in the middle section where the rates are, this is actually mirroring the actual rate environment that we had in Q1 of 2015. So going back to that quarterly hedge versus annual hedge chart that Ian was showing, we had, as it was dropping off from the 130s, dropping rapidly, a blended rolling hedge rate for that quarter would have been 1.315. So still benefiting from a lot of the prior hedges at the higher level. The last layer that was added to this quarter would have been at the 121 level, but it would not have brought down the hedge rate too far. So you would have had a hedge rate of 1.315. You can see what the accounting rates actually did in January, February, and March. So it dropped from down to 113, then just under 112, and then 107. So your weighted average for the quarter was just a little over 110. So really huge difference between your hedge rate and your accounting rate. And then in this example, I'm assuming a planning rate that was communicated that shouldn't be too different from your hedge rate. Maybe we're leaving a little bit of room for error, being a little bit conservative in terms of communicating a planning rate of 130 to the business. So if you look at then the bottom section of this is the analysis of all the variances. So what would actually happen, of course, the revenue, the 98 million euro revenue at a planning rate of 130 would have been 127.4 million US. So that's sort of what the businesses are expecting. You told them a rate, that's what they're hoping for. Well, the actual revenue with the accounting rate, which is far less, that's 108 million, that's 19 million less revenue that actually came in during that quarter at the respective accounting rates. So a huge delta there. The hedging is largely doing its job. If you look at the FX hedge gain loss, you have almost a $17 million gain, and then so the net business impact is really the net of those two numbers, and it's just over a $2 million loss. All right, why is it not zero? Why do we have a $2 million loss? Two impacts there that they're actually offsetting in this example, and the one is I'm lumping in the policy of hedging 80% along with forecast deviation. So the forecast deviation impact is negative because we only hedged 80 million. So it's really that actual forecast deviation of 2 million would have been actually favorable because that would have been an over forecasting, but it's the under hedging based on just doing the 80% that is causing about a 3.4 million impact overall to the results there. And then on the other side, you actually had a favorable rate deviation, and this is again that difference between the planning rate and the hedge rate, 130 compared to 1315, that gave you a $1 million gain in terms of the rate deviation. So this is the type of thing that would help build a bridge to the business so they understand, all right, I didn't quite get 127 million, I got about 125 million, but it's a lot better than 108 million if you weren't hedged. They can understand the results. And with that, I will turn it over to Ian, and he will talk about some hedge accounting.
Yeah, thanks, Scott. So I think Scott has done a really good job of explaining how the volume and rate drivers impact your hedge performance. And I just want to take a minute to go through hedge accounting because it's really the key tool that you have to align what's going on from an economic hedge perspective and what shows up on your financial statements. So in the first row here, we've got three graphs. The first one shows the exposure, so what the profit and loss would be as the FX rates change. And the second graph shows the future cash flows of the hedge. So as rates increase in this case, your revenue might increase, and then your hedge may have an offsetting perspective. And from a net cash flow perspective, you're flat. So if you're hedging to the cash flow date on the revenue side, your hedge should perfectly or nearly perfectly offset your exposure, aside from a little bit of noise. Now the next two rows show what happens from an accounting perspective. Now your exposure, nothing is realized on the FX gain or loss from an accounting perspective until, as Scott mentioned before, it becomes an invoice that's been issued. Until it's a receivable, nothing happens. But you've got this economic hedge out there that's posting gains or losses to your foreign exchange gain and loss line in your income statement. So you get this misalignment between what's happening from an accounting perspective on the third chart on the far right on the second row and what's happening from an economic perspective. Economically you're hedged, but from an accounting perspective, you've got this one-sided noise from the derivative. And the only way to combat that is to take your exposure and designate it for hedge accounting. So you put your derivative on, and what happens is not carried through the gain or loss in the derivative on the second graph is not carried through to profit and loss, but it's carried on the balance sheet and as a component of owner's equity. So your accounting gains or losses on the income statement now line up what's happening economically. So that without this cornerstone or this tool in place, it's very difficult to align what happens from an economic perspective to an accounting perspective. So a couple of more benefits just of the cash flow hedging program. I think as we just showed and walked through that it's an alignment of the accounting and economics from both the where does it happen on the financial statements and also the timing. A key result of that is reduced profit and loss volatility because the item is deferred until the revenue or expense is realized on the income statement. You don't get that volatility from the derivative mark to market. Just to run the program, because you have to forecast with a certain amount of certainty, there's just an amount of discipline and planning. So you need to be close to your exposures and your businesses that this type of program requires. And it often ends up in improved economic hedging because you're hedging the exposures that you know better and that you have to not materially different from the estimate. The challenges, it's not the simplest thing in the world with the new accounting pronouncements under the IASB and FASB. It is getting easier, but it still requires a lot of knowledge and specialized tools just to manage it. And in certain cases, it's difficult to obtain hedge accounting. If your forecasts are not very certain at all, then you're not able to do it. And also, this is relevant for here, but within commodities, it's often much more difficult. So I think that takes us to the bottom of the half hour. I'd like to thank everyone for joining. Our just bios and the information will be up on our website, so you can download it, and there'll be a recording as well. Any questions, feel free to reach out to us. And thanks again for joining, everyone.
Yep, thank you, everybody. Appreciate the time.